All right, welcome into the channel. My name is Craig Swanson. I am the managing partner of Swanson Reserve Capital. I get a lot of requests for social proof on how structured notes work. And one of the things that I would stand by, and this is not financial advice, I'm not recommending any of the things that I'm going to show you today as far as a recommendation to buy or sell. I just want to show you social proof of how structured notes work, how one of them is just getting called effective yesterday on Halloween. Happy Halloween, everyone. Had a note that I'm flashing up on the screen get called for 30% and kind of walk you through what that looks like. So we bought a structured growth product issued by BNP Paribas. This is the bank that is backing the structured note. So when you buy structured notes, you're taking on the credit risk of BNP Paribas. All the banks that we're buying from are those that you've likely heard of: Goldman Sachs, JP Morgan, Morgan Stanley, BNP, among others. And they have to have a good credit rating for us to even consider them at least BBB on the Moody's scale. So what happened here? This is a quick oversight of what are the pros and cons of investing in structured notes. And this is what I love about this investment class. I wouldn't recommend this to be your entire portfolio, guys. I have a lot of my net worth in this because I believe in it so much, and I feel like I sleep well at night with this. So this structured growth product follows the equities of Amazon, Google, and Microsoft, as you can see right here. These are the three. It is the worst of, meaning whatever performs worst, it's going to track that. These were the current levels in which we bought in at. So you're locked in at these trade prices. This is a 3-year note. Here's what our initial level was. So obviously these all went up this much. So if this were technically tracking a lesser of, we would have only gotten 20.18%. Now here's where it gets really cool and how I think there's an advantage to structured notes, but also a cap, right? So if you were in Google or Amazon during these time periods, you would be up 40%, 37%, 20% in these equities, but taking on the full risk of them going down, possibility of them not performing as well. This locks you in. This is where I really enjoy the structured note product. As long as these three go up 1 cent from the initial levels as it's done from the jump, as you can see, these are the 3 lines that correlate to Google, Amazon, Microsoft price. As long as they stay above this level, or at least 1 penny in the period of 3 years, we make 30%. And that happened in this case. So the market had a good year. Obviously these equities went up, but there's a lot of protection built in. And I want to show you kind of the difference between investing in the market and a structured notes. The protection on this is 40%. You can see here, 40%. Soft is just the term they use in our world, but it means all these equities could go down 40% and you will have not lost a single cent until one of those equities has breached that barrier. If that happens, then you're down dollar for dollar for that. And this lasts for the 3 years, the 36 months of the note. Essentially, your risk and what you're taking on is the credit risk of BNP, the risk of these 3 very large cap companies, obviously not going up a penny within 3 years. That's the risk. They need to go down 40% and stay down 40% over 3 years for you to lose or have a risk of losing any of your initial principal. If this were to go out multiple years, and let's just say it didn't happen this year, right? Like let's say we're going into a tough year with elections or uncertainty, it would roll out and you wouldn't have a 30% call premium on this particular note. On some we do, on some this just doubles year over year up into the 3 years. So an example, if this got called on year 3, you'd make 90%. What this has on it is a participation kicker. Basically, it's a 350% on the lesser performing. So if Amazon did 10%, you would get 350% of that whenever the note gets called. So you're going to get this 3.5x performance on any of these worst performing securities. As we back test and look at these securities, these essentially are following the trajectory or path of QQQ, which has been highly favorable. So the trade-off and the risk reward of having the 40% downside, the opportunity to make 30%, if not far and above more that with the 3.5% multiplier on this particular note, made it seem very attractive for us and what we were looking for our investment portfolio. I hope you found this useful. Ask any questions you have in the comments and be happy to talk to you at Swanson Reserve Capital. This is what we specialize in. 60% of our portfolio is growth notes and really love this type of investing. So again, questions, drop them in the comments below, but thank you for watching.